Today, we're diving into SoFi's recent disclosures about their loan portfolio's default rates and some concerning forecasts for future delinquency rates. We'll explore the specific metrics SoFi has shared and discuss how this impacts the company's ability to attract customer deposits, which amount to billions every quarter. Finally, we'll look at what this means for SoFi stock investors. Hello, everyone. Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But before that, alert, this is not a financial advice video. Let's start with the specifics of SoFi's loan portfolio. SoFi reported that their 90-day student loan delinquency rate is at 13 basis points, with an annual student loan charge-off rate of 60 basis points. This is relatively low compared to their personal loan portfolio. For instance, in Q1, the 90-day delinquency rate for personal loans stood at 72 basis points. Clearly, personal loans have a significantly higher default rate compared to student loans, almost 6 times higher. Why is there such a stark difference between student and personal loans? It boils down to how these loans are treated in bankruptcy courts. Generally, student loans cannot be discharged through bankruptcy. They remain on the borrower's credit report indefinitely unless paid off or forgiven by the government. This permanence is why borrowers prioritize their student loan payments over personal loans when facing financial difficulties. On the other hand, personal loans can be wiped out in bankruptcy, providing a fresh start, though it does come with a severe hit to the borrower's credit score. The difference in how these loans are managed becomes more pronounced during economic downturns. In times of increased unemployment or recession, individuals are more likely to default on their personal loans before their student loans. Despite a slight decrease in the annualized personal loan charge-off rate from 4.2% to 2.45% recently, this reduction is somewhat misleading. SoFi sold off some delinquent loans, artificially lowering the reported charge-off rate. Looking forward, SoFi anticipates a normalization in credit performance to pre-pandemic levels, expecting life of loan losses to be between 7 to 8%. While they frame this as a return to normalcy, it actually implies a significant increase in defaults, potentially doubling the current rate. This anticipated rise aligns with the broader economic context. During the pandemic, extensive government stimulus and enhanced unemployment benefits bolstered consumer finances, leading to lower default rates. However, as these supports have waned, so has the robustness of consumer balance sheets. During the pandemic, the government injected trillions of dollars into the economy through stimulus checks and unemployment benefits. This influx of money allowed many individuals to pay down high-interest debts and build up their savings. Consequently, default rates remained low, even as the economy reopened. However, these conditions were temporary. As the stimulus faded, savings began to deplete, and the cost of living surged. Essentials like rent, fuel, food, and clothing have become more expensive, leaving less disposable income to service debts. This trend is expected to continue, worsening individual financial situations and potentially increasing default rates further. SoFi's management is aware of these dynamics and is taking proactive measures. They plan to issue fewer loans in 2024 than in previous years, acknowledging the higher risk environment. This cautious approach is designed to mitigate potential losses and safeguard the company's financial health. Despite these measures, there is still a risk that default rates could exceed SoFi's projections. If defaults surpass the expected 7 to 8%, SoFi could face significant challenges. However, as long as the company's forecasts hold, they should be able to navigate this period without major disruptions. In summary, SoFi's recent disclosures provide a mixed bag for investors. While the company is taking steps to manage increasing risks, the anticipated rise in default rates is a cause for concern. Investors should keep a close eye on these developments and consider the broader economic trends that could impact SoFi's performance. As always, a cautious and informed approach is key when evaluating the potential of SoFi as an investment in the coming years. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.